One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights, the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. My name is Alex Mason and I am your host. And we're talking about technicals right now. We're talking about some of the more advanced M&A concepts. And I'm traveling on the road today, so just doing a quick one here for you. And we're talking about deferred tax liabilities and deferred tax assets specifically. So today's question is this: why do deferred tax liabilities and deferred tax assets get created in deals? Now, it's been a while since we really talked about this concept, and just kind of digging back into these definitions, we cover this a little bit in episode 177. Deferred tax liabilities, or DTLs, they get created when assets are written up in a transaction. So if one company is buying another and the value of, say, a factory is actually worth more than what has been assumed for tax purposes on the books of the target company, well, that asset gets written up in value. And what that does is it creates a liability on the combined company's balance sheet, because now it's like the tax authorities are going to say, oh, well, that asset is actually worth more than what it was before, according to the books of this company in the past. So in the future, you're going to have to pay more cash in taxes. So that's why it's a deferred tax liability, because the value is going up. On the flip side, we have these things called deferred tax assets, or DTAs. Deferred tax assets get created when assets are written down in a transaction. So you can imagine the opposite scenario happening, right? One company is acquiring another, and then the company that acquires the other business, let's say there's a factory that is actually worth less than it was on the tax books of the target company. And so the government is basically like, oh, okay, there's already been a certain amount of taxes paid for this asset, but it's actually worth less now in the future. So you're going to owe less cash taxes in the future from the perspective of the combined company. So that's why it becomes an asset and goes on the asset side of the balance sheet. And just so you know, like, where that falls within the asset side of the balance sheet, it would be in like the other assets section. So that's where you would see it. And yeah, so why do these assets and liabilities get written up and down during a deal? It's just because that what they're worth in terms of the book value, it's just not always the same as what they're worth in the market at the time. And we kind of come back to this concept again and again of the differences between book value and market value. Like, this is where goodwill comes from. This is where deferred tax assets, deferred tax liabilities come from. Essentially, what we're accounting for is a timing discrepancy. There's a timing discrepancy between when taxes are owed and when taxes are paid, and the value of the assets that's recorded at different points in time. So the discrepancy basically is accounted for in order to make the transaction of the acquisition itself more clear and accurate. So that's what I got for you today here on Investment Banking Insights. Now, what we're going to do in the next episode is we're going to get a little more detailed into this. We're going to talk specifically about deferred tax liabilities and deferred tax assets, how they affect the balance sheet in deals. Because it's important for us not just to understand these things from a big picture conceptual level, but also to get a little bit more nitty gritty and understand the details of how does this actually work in impacting the financials of the combined company. So we're going to walk through an example tomorrow, and hopefully that'll give you a little bit more understanding. All right. Thank you so much. Hope you're having a wonderful day. Take care.